All of last year, the question was, who's going to buy these bonds? And that dynamic has changed, and changed pretty radically.
Yeah, changed very quickly, and it turns out everyone wants to buy these bonds. Investors globally are gobbling up this issuance. You know, we're seeing this record issuance alongside a bond rally that's really showing us the strong demand that's behind these deals. Yields are tasty, and investors don't want to miss out on after such a low era such a long era of low yields. And look, I think they're probably looking ahead, seeing that we're pricing in central bank cuts later in the year. Investors are really keen to lock in these high yields while they can. And look, perhaps the best place to hide out if we do see some global economic downturn is in these bonds.
Tasty yields. Yeah, yields of what, 5% on some of these portions of the debt market look pretty attractive when PPI is coming in a little above 6% out of the US yesterday. Take us through and talk us through where that issuance is coming from.
Yeah, so in Europe, financials have had a hefty amount of issuance, but the region as a whole saw its biggest week ever, up 40% from last year. Asia, there's a decent amount of corporate dollar bond activity that's alongside, China reopening narrative. People are very willing to invest in Asia. EM sovereigns issuing in both euro and dollar denominated debt. Now listen to this, Tom. So far, the issuance from EM equals 40% of the entire sales from all of last year. And as you mentioned, it's only been 2.5 weeks in January.
So EM really taking advantage.
It definitely. Let me just rattle off some people have come to the market. Saudi Arabia, the biggest emerging market sovereign debt deal in almost 3 years. They issued $10 billion. Hong Kong, Hungary, Israel, Mexico, Turkey, Mongolia, and there's a few others in the pipeline. EM is really having a blast.
Any sector that isn't looking so strong?
The one sector that is lagging is high-yield corporates. Now, in terms of issuance, they really took advantage of the low yield era to extend the maturity of their debt profile. So they don't necessarily need to come to the market at the moment. They might as well wait and maybe be patient for later in the year if we do see yields decline, where they could borrow at lower rates. The other one that's been soft is Japanese corporates. Again, that's not surprising. Their deal flow has plunged 70% versus last year, but we've had a lot of tumult, especially in the sovereign bond market, as the BOJ looks at their yield curve control and liquidity in the sovereign market dries up. It's not surprising that corporate does as well.
So high yield and Japanese corporates not issuing as much. When it comes to default rates, though, we heard from Howard Marks saying, look, the normal is 4%. We're at about 2% now, but he thinks we get back to 4% in terms of default rates. That's a risk.
It's definitely a risk, Tom. It's definitely a risk. But look, I think investors are seeing these level of yields. They understand that risk reward, but it's still attractive even with those downside risks in mind. But you're correct. Profit margins for both IG and high yield have declined. That I guess elevates the risk of some sort of a default risk that you have to bake in there. But maybe it is the calm before the storm. If we have a hard landing in the later half of this year, we could see default rates spike. But investors at the moment see these yields and want to gobble them up.